There is a silence that every market participant has felt. It is the cold, heavy quiet that follows a catastrophic financial loss. It is the moment you stare at the screen, at a number that was once your capital, now a fraction of its former self, and you realize the game has stopped for you. The crowd feels this as a personal failure, a betrayal by the market. They see it as an attack. But the professional sees it not as a tragedy, but as a preventable failure of process. They understand that the market did not take their money. They gave it away through a lack of discipline. This is the great dividing line not between winning and losing, but between survival and extinction in this arena. The foundation of a long and profitable career is not built on brilliant predictions or complex strategies. It is built on a single, unshakable principle: the preservation of capital above all else. The untrained mind is magnetically drawn to the question of potential reward. How much can I make on this trade? Is the siren song that leads countless accounts to their ruin. It is a question rooted in greed and fantasy. The professional, the student of the tape, asks a different question, a colder and more critical one. What is the maximum I'm willing to lose if my analysis is wrong? This shift in perspective is everything. It moves the entire operation from the realm of gambling to the realm of calculated business. The uninformed participant sees a stock moving higher and imagines a new car or a vacation. The seasoned operator sees the same movement and immediately calculates where the idea is proven false, where the exit door is. They are not focused on the destination. They are obsessed with the structural integrity of the vehicle that will get them there. Their vehicle is their capital. Without it, the journey is over before it begins. Let us consider the brutal mathematics of a significant drawdown. These numbers are unforgiving and expose the folly of taking large risks. If you have an account of $10,000 and you suffer a 25% loss, your capital is now $7,500. To return to your starting point, you do not need a 25% gain. You need a 33% gain on your remaining capital. The math gets exponentially more difficult the deeper the loss. A 50% loss, turning $10,000 into $5,000, requires a 100% return simply to break even. A 100% return is a monumental achievement, something most will never see. A 50% loss, however, is frighteningly common for those who ignore the rules of the game. They treat each trade as a lottery ticket, hoping for the big win, while the professionals treat each trade as a carefully managed insurance policy against their own fallibility. They know they will be wrong, often. Their entire system is designed to ensure that being wrong is merely an inexpensive business expense, not a career-ending event. This brings us to the first law of survival, the bedrock upon which all successful speculation is built. Never risk more than a small, predetermined percentage of your total capital on any single idea. Jesse Livermore, one of the greatest speculators to ever live, operated on a strict 10% rule for his entire account. For the modern participant, especially those starting out, a much more conservative rule is warranted. The industry standard, and for good reason, is to risk no more than 1 to 2% of your total trading capital on a single trade. This is not a suggestion. It is a law. It is the governor on the engine of your greed. It is the circuit breaker that prevents a single bad decision, a single unexpected event from causing a total system failure. Adhering to this rule ensures that you can withstand a string of consecutive losses without suffering irreparable damage. 5 consecutive losses at 2% each results in a 10% drawdown. This is a recoverable situation. One single loss of 50% is a financial crisis from which most will never return. So, how does one translate this abstract rule into concrete action? This is where the mechanics of risk management come into play. It begins with knowing your total account value. Let us use a round number for clarity, a $20,000 account. A 2% risk rule means that the maximum dollar amount you are permitted to lose on any one trade is $400. This number is your constant. It is your North Star. Before you even consider buying a single share, you must know this number. It is the foundation of the entire calculation that follows. The crowd thinks in terms of shares. I'll buy 100 shares. The professional thinks in terms of risk. I will risk $400 on this hypothesis. The number of shares is the last thing they determine, not the first. Let's visualize this process. You have identified a stock that appears to be under accumulation. It has been in a long trading range, and you believe the large operators are absorbing shares in preparation for a markup phase. You see a specific pattern, perhaps a spring, which is a shakeout below the support level of the trading range that quickly reverses back into the range. You decide that if the price breaks below the low of that spring, your entire thesis is invalidated. The market will have proven your analysis incorrect. This point of invalidation is your stop loss. It is not an arbitrary price. It is a logical location based on the market's own structure. Let's say the current price is $52, and the low of the spring is $50. Your risk per share is the difference between your entry and your stop loss. In this case, it is $2. Now you take your predetermined maximum dollar risk, which we established was $400 for our $20,000 account, and you divide it by your risk per share, which is $2. The result of this calculation is 200. This means you are authorized by your own business plan to purchase 200 shares of this stock. Not 100, not 500, exactly 200. By doing this, you have engineered the trade so that if you are wrong, if the price drops to $50 and your stop-loss order is executed, you will lose exactly $400, which is precisely 2% of your capital. You have contained the potential damage. You have transformed a speculative guess into a controlled experiment with a known, acceptable downside. This is the work of a professional. It is calm, logical, and devoid of emotion. It is the opposite of the hopeful, high-stakes gambling that defines the actions of the uninformed public. The setup for this method is not on the chart itself. The setup occurs in your mind and in your trading journal before the market even opens. It is the commitment to the rule. You must decide with absolute conviction that you will never deviate from your percentage risk parameter. It is a promise you make to your future self. The trigger for action is the completion of the position sizing calculation. You do not enter a trade until you have identified your entry point, your logical stop-loss point, and have calculated the exact number of shares that corresponds to your acceptable risk. If you cannot define a logical stop-loss, then there is no trade. If the distance to the stop-loss is so wide that the resulting position size is trivially small, then you must pass on the trade and wait for a better opportunity where the risk-to-reward ratio is more favorable. The market offers a continuous stream of opportunities. There is no need to force a suboptimal one. Your stop-loss order is not a sign of fear. It is the ultimate tool of capital preservation. Once you enter the trade, you place a hard stop-loss order in the system at your predetermined price. You do not use a mental stop. The human mind is a master of self-deception under pressure. When a trade goes against you, the voice of hope will begin to whisper, "It will come back. Just give it a little more room." This is the beginning of a catastrophic error. Moving your stop-loss to accommodate a losing position is the equivalent of a ship's captain ordering the crew to ignore a hole in the hull because they hope the water will stop flowing. It is an abandonment of logic in favor of wishful thinking. A professional honors their stop-loss. When it is hit, there is no anger or regret. It is simply the cost of doing business, the price of discovering that a particular hypothesis was incorrect. The loss is accepted, the trade is reviewed, and the trader moves on to the next opportunity with their capital largely intact. To truly internalize these concepts, the serious man must return to the source. The foundation of modern technical analysis is contained within Richard Wyckoff's masterpiece, How I Trade and Invest in Stocks and Bonds. This is the original, timeless wisdom, presented in the Annotated edition by Max Davidson. The annotations provide necessary context and clarity for the modern environment, ensuring the original principles of trading as a serious business, risk management, and judging the market by its own action are preserved. The link to this book is in the description below. Understanding these foundational texts is not about memorizing patterns. It is about absorbing a philosophy of market operation that has stood the test of time. A philosophy centered on the idea that the market tells its own story through price and volume. And our job is to listen, not to predict. Now, let's consider what happens when things go right, because risk management does not end after the entry. Suppose your trade works. The stock moves from $52 to $58. Your position is now showing a healthy profit. The temptation for the novice is to take the profit immediately, driven by the fear that it will vanish. The professional, however, manages the upside with the same discipline as the downside. This is where a concept like a trailing stop comes into play. You might move your initial stop loss from $50 to your break-even price of $52. At this point, you have removed all risk from the trade. The worst-case scenario is now a scratch trade with zero loss. This allows you to let the profitable trend run, giving you exposure to the large gains that are necessary to offset the many small inevitable losses. Big money is not made by scalping small profits. It is made by correctly identifying a major trend and having the discipline to stay with it. Risk management is what gives you that staying power. What if the opposite occurs? What if you experience a string of losses? This is the ultimate test of a trader's psychological fortitude. Let's say you take 6 trades in a row, and all 6 hit your 2% stop loss. Your account has now experienced a 12% drawdown. This is painful, but it is not fatal. The critical action here is not to increase your risk to win it all back. That is revenge trading, and it is the fast track to insolvency. The professional response is to do the opposite. You reduce your position size. Perhaps you cut your risk parameter to 1% per trade until you regain your footing and market conditions become more favorable. This is an act of self-preservation. It is an acknowledgement that your timing is off, or your analysis is not in sync with the current market behavior. It is a defensive maneuver designed to protect your remaining capital until you can go back on the offensive. A general who loses a few small skirmishes does not respond by sending his entire army into a single desperate charge. He pulls back, assesses the landscape, and waits for a high-probability moment to re-engage. We must also confront the most dangerous scenario, the temptation to abandon the rules entirely. Imagine you place a trade with a $2 stop. The price drops, comes within cents of your stop, and then violently reverses in your favor, rocketing higher. The novice experiences this and thinks, "My stop was in the wrong place. I almost got shaken out. Next time I won't use a stop." This is a disastrously wrong conclusion. The correct conclusion is that your stop placement was precise and logical and you were nearly proven wrong, but the market structure held. The near miss validates the process. The alternative, where you remove the stop and the price continues to fall, leads to a 20, 30, or 40% loss on a single trade. A single event of that magnitude can inflict so much psychological damage that a trader may never recover their confidence. The rules are not there to prevent you from ever losing. They are there to prevent you from losing everything. The concept of risk extends beyond the single trade to the portfolio as a whole. Many uninformed participants believe they are diversified because they own 10 different stocks. However, if all 10 of those stocks are in the same industry group, such as semiconductor manufacturing, they are not diversified at all. They have made a single, concentrated bet on that one sector. A piece of bad news affecting the entire industry could cause all 10 positions to move against them simultaneously. This is a hidden correlation risk. A professional operator understands this. They manage their overall portfolio exposure. They ensure their positions are spread across different, uncorrelated sectors. If the general market is in a confirmed downtrend, they will not be taking many long positions, no matter how good the individual setups look. They respect the tide. Attempting to swim against a powerful market tide is a low-probability, high-risk endeavor. True risk management is a top-down affair, starting with the health of the overall market, then the strength of the sector, and only then analyzing the individual stock and calculating the trade parameters. Capital is your inventory. For a shopkeeper, inventory is the product on the shelves. If they allow their inventory to be damaged or stolen, they are soon out of business. For a speculator, your capital is your only inventory. Every dollar lost is a piece of inventory that is gone forever. Guarding it is your primary function. The goal is not to have a perfect record of winning trades. No one has that. The goal is to ensure that the sum of your winning trades is significantly larger than the sum of your losing trades. This is only possible if you keep the losing trades small and controlled. A single large loss can wipe out the profits from 10 or 20 successful small wins. The math is relentless. Therefore, the focus must always be on the defensive side of the equation. Master the art of taking small losses before you ever dream of chasing large gains. In conclusion, the path to longevity in the markets is paved not with brilliant forecasts, but with unwavering discipline. It is the quiet, daily practice of risk management that separates the professional from the amateur. It is the understanding that you are not in the business of being right. You are in the business of managing probabilities and containing losses. The 2% rule or a similar conservative parameter is not a guideline. It is the central pillar of your entire operation. It dictates your position size. It protects you from your own emotional impulses. It ensures that you can survive the inevitable periods of drawdown and uncertainty. It keeps you in the game, preserving your capital so that when the truly great opportunities arise, the once-in-a-season trends, you will be there, fully funded and ready to act. That is the essence of professional speculation. It is a business of survival first and profit second. If you want to understand more about how to identify the high-probability opportunities where this risk should be deployed, stay with us.